good afternoon, everybody. For those of you who don't know me, my name is Aditi Kumar. I'm the Executive Director of the Belfer Center, where I run the Economic Diplomacy Initiative, along with Professors Nicholas Burns and Larry Summers. We're very lucky today to have with us Martin Mühleisen. He's the Director of the Strategy, Policy, and Review Department at the IMF, speaking to us about what the fund is doing to mitigate the economic fallout from the coronavirus. Welcome, Martin. As I said, Martin is the Director of the Strategy, Policy, and Review Department at the IMF. In this capacity, he is at the forefront of the IMF's efforts to combat the ongoing crisis, and also to coordinate with international bodies like the G20 and the United Nations. We can benefit today from his experience, I think, spanning nearly 3 decades at the IMF, where he has worked on the 2008 financial crisis, the 2012 euro crisis, the 2014 Ebola response, among others. So just to share some top-level figures, I'm sure you all have read up about this, but over 100 countries have asked for emergency financing from the IMF to date. I believe, Martin, and you can correct me, that about 45 or so have received it so far. And of the total about $1 trillion lending capacity that the IMF has, about 1/5 of it has been committed so far. So thank you so much for being here and sharing your perspectives on this unprecedented situation. I'm sure our students have a lot to learn from you. So thank you, and over to you.
Thank you very much, Aditi. Thank you for the nice welcome, and thank you for giving me the opportunity. And I'm glad I can take a little bit of time off and explain what we're doing. Usually we're engaged in all these negotiations, and sometimes, you know, we also sometimes forget about the big picture. And these talks are always a nice opportunity for ourselves to actually rethink a little bit what we're doing. And so let me just share you some of our thinking and where we are. And perhaps I was asking Aditi at the beginning, should I talk a bit about the IMF as an institution, actually who we are? And I think it's probably a good thing, because a lot of the issues that we're going to be discussing that are so difficult in this particular crisis come back to what the IMF is and how it was set up. So going back to Adam and Eve, or maybe more precisely to Lord Keynes and Harry Dexter White, the IMF is, if you want, it's a bit like a credit union. That's how it was set up, where countries that are members of the IMF pool their resources, and if one is in trouble, they're going to ask the others to come and help them out of a temporary situation. Then the money gets repaid and everybody is better off. So that's the principal idea. And the IMF is an institution rooted in international law. We have over the more than 75 years now that we exist, we have quite also a big body of internal decisions and rulings, very important legal department. We are very rules-based on the basis of everybody gets the same treatment, whether they're a large country or a small country, very importantly for an international institution, of course. And we're part of the broader UN family, but we're not in any way a UN agency. We're in a sense independent, but we're very closely affiliated with the United Nations, in particular when it comes to the voting in the IMF. So at the UN, usually you have one country, one voice, one vote. In the IMF, it's a bit more complicated because there's a lot of money at stake, and the larger countries have more money at stake, so to speak, and they also have a bigger weight in the global economy. So our voting shares are determined on the basis of countries' role in the global economy, if you want. There's a complicated formula, but essentially what it means is that, and that's how it was set up, is that the United States, for example, has an important veto on key decisions. The US voting share is about 17%, and some of the decisions that really affect the existential issues of the institution all require an 85% majority, so you can do the math. But it doesn't mean that the US is the only kind of country that could influence decision at our executive board or in the membership, of course. We have many decisions that require 50% majority, and if you add the the votes of other countries together, you also get blocking majorities, minorities sometimes in some cases. So it's an institution that over the years has relied a lot on the consensus principle. And of course, in the end, as the game theorists among you know, that negotiations, of course, are being governed by the initial positions, but the system has worked quite well. Now, it is being challenged in recent years by the emergence of emerging markets, as the name says, and in particular China. And the question of how much weight to give these emerging countries at the expense of who is kind of a fundamental issue that comes back time and again whenever we do a review of these formulas and of our membership votes and the like, which happens every 5 years. It's related to questions about the IMF's capital. So that's a dynamic that's been ongoing already for many years. But coming back to the nature of the institution, what really happened back in '44 was that the idea was the members of the IMF would pool their reserves. And at that time, it was mostly the gold. And so the IMF, when it was set up, really got a ton of foreign exchange reserves, literally speaking, from their members. And we still are one of the biggest gold owners on the planet, if you want. In return, what the countries got was a claim in the IMF. And that claim is equivalent to gold. It's equivalent to foreign exchange reserves. So the financial solidity and the balance sheet of the IMF is of fundamental importance to our members because it directly affects their foreign exchange reserves that they can show in their balance of payments. And any risks to that, of course, is something that no member would contemplate. So the fundamental principle that governs what we do is whenever we make a loan to a country, is we have to be certain it's going to be repaid. And certain as in, it really better be sure that in the end we're going to be repaid. So we have a very high standard for when we can lend and when not. There's a very complicated lending framework in place. We do debt analyses, we do safeguard assessments. We need to ensure that when we do lend money to a country, that the underlying problems that led the country to come to us in the first place, to the IMF, have to be solved within a reasonable period. And that explains why the IMF asks countries to do certain policy measures in the form of conditionality. That conditionality is the only security we have, if you want, for us to lend. We're not asking for collateral. We're not asking for assets of a country that are being put into some escrow account and that would be coming to the IMF if they couldn't repay. No, it is the quality of the policies of the member country and their willingness to undertake the needed reforms that is the security that we have. And so against that background, we need to assess constantly once we make loans whether the member can repay us. And in the current circumstance, of course, it's a little bit difficult because, as you can imagine, the global outlook is very uncertain. We don't exactly know how the global economy will evolve. There are lots of countries, both poor and rich, that have a lot of debt in their hands. And so coming to judgments here on what is still justifiable under our lending framework and what not, that is sometimes a bit difficult. But I'll get to that in a second. Maybe last thing is that we do have different instruments, how we lend, depending on circumstances, governed by this fundamental principle that I just mentioned. But if there is a temporary balance of payments problem that a country has, then we have like more of a short to medium term instrument that has to be repaid a bit more quickly. If a country has deep structural issues that it needs to sort out, then we have programs that can go up to 4 years and that have a longer repayment period because we understand that countries take their time to repay it. And we do have emergency facilities that used to be for countries that, for example, suffer an earthquake or a flood or other natural catastrophes. And this facility has now quickly been upgraded so that we can also lend in the case of there's a global pandemic. And what we also do have, and that's the final thing before I go into the actual crisis, is we do have two types of programs. One, the regular ones, and then another one that is for poorer countries, for low-income countries. And these are more at subsidized terms. So these low-income programs have at the moment 0 interest rate, and they have a pretty good repayment schedule that helps countries repay us more easily. Now, the costs of that, the subsidies that are being provided, they don't come from the IMF. We cannot do that by our statutes, but we have a lot of countries, larger countries, that are supporting us with loans, separate loans, and also in some cases grants that finance these cheaper loans to poorer countries. And that has really helped, and that is the backbone for us to do this kind of cheaper loans. And it's a very important part of how we can help low-income countries, because if they would get only our normal terms, they would have big difficulties repaying it, and then we wouldn't help them, we wouldn't help our own balance sheet, and most of all, we wouldn't be of any good to the people in these countries. So these donor funds that we get to do the subsidized lending is a very important part of the story. So, okay, and now let's get to the story. We have this unprecedented crisis at the moment. Never had it before, right? We know debt crises, we know foreign exchange crises, we know crises in currency unions, but hey, a pandemic where the origin of the crisis is not even an economic issue. It's a health concern that we never had before. And so we had to, quickly get up to speed. We've done some kind of risk scenario a little while back, thinking about such a pandemic. And the insight that we had at that time was, well, there's not really much we can do to prepare for it. We just have to be ready to deal with a lot of cases that would come. And so it is. So with all the uncertainty and all the lockdown of the global economy that leads to a major correction in our growth outlook, as you may have seen from our World Economic Outlook, a lot of countries are now in a position where they have to support people, first of all. Second, support the health response. And third, kind of try and preserve the structure of the economy. You don't want to have waves of bankruptcy after this crisis is over. So you need to support your productive capacity. And for that, you need money. And well, you've seen it in the US, and you've seen it in other advanced economies and larger economies. They can put up stimulus programs of enormous amounts that we really haven't thought about that any time before. I mean, who would have thought that the US deficit goes into, the trillions, not just 1 trillion, but trillions of dollars potentially this year. And same with Europe, same with Japan. China had large expenditure. Everybody has that. And many countries can do that. They can issue debt, and they have to think about later how to deal with it. But for now, they have the means to provide a response. Clearly, it's not perfect. Clearly, lots of problems for people that lose their jobs. But by and large, the countries have the tools to protect their people and their economies from the worst. Then on the other side of the spectrum, there are very poor countries that are now being hit by not only the pandemic, but also, for example, by falling commodity prices, plus the lack of demand for whatever export goods they may have. And they don't have the means to provide that type of support to their economy and their population. They don't even have the right means sometimes to provide the health response. And so, where can they go? And the answer is, well, there's a lender of last resort, and there's the IMF, and therefore we have about 100 or so requests and inquiries for these emergency tools. It's not a lot of money, mind you. It's limited because we don't have the same conditionality that we would usually ask for. We just need to demonstrate that that is sustainable, which is, as I mentioned, hard enough in some cases. But that means also that we can't do the same amounts of lending as we would do under normal circumstances if a country comes to us. So then there's a bunch of countries in the middle, and these are usually emerging markets, maybe some frontier markets, or some smaller advanced economies. And these countries, they tend to have good solid foreign exchange reserves, they tend to have good policies, and so they have a bit more room to support their economies. The big question that we have right now is, if this crisis continues for another few months, how long will some countries last? Will they, in the end, also have to come to the IMF? And will they need bigger amounts? Because for these countries, our emergency financing is too small. It would maybe, last for a month or so, and then they would have to come back. And so they may need bigger programs. And then in that situation, will they be able to repay us? Will other countries be able to repay us? So this question of how we assess debt and what safeguards we have is very central. In that context, a lot of debate has happened in the press about debt relief and can we maybe forgive debt? What about the debt standstill? Can we push things out so that countries have to repay later? That is a very important debate. It helps right now with the liquidity in the sense that it frees up dollars that countries need to pay for health equipment, for example. But it doesn't solve the underlying issue, which is really the debt sustainability. But that's something in the sense of a good triage that we've put a little bit back. Right now, we're really focused on providing that emergency finance. I think we're through about a bit more than 30 countries, not quite 45 yet or so, but we're processing them at a big speed. And maybe one last word on the resources. So yes, we do have about $1 trillion in financing capacity. What we're looking into at the moment with these many requests that we're having is actually a very small part, both because the countries that typically ask for it are smaller and the access is not that high. So I think we're talking of a dimension of possibly up to 60 billion at the moment. And that's US dollars. So compare that to 1 trillion. And yes, we do have some loans that are already outstanding. And so that leaves you with a pretty big capacity still available for us to lend. If we get a couple of big countries, then, we're getting toward an area where one has to think about resources of the IMF, but we're clearly not there yet. And we'll have to see how the crisis goes.